This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Michael back on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Michael's picture saying, looking for the downloads.
Patrick, this week you're taking the other side of one of the hottest trades on the planet, South Korea's AI-fueled rally in technology stocks. You've got a relative value setup that pits the Kospi against the NASDAQ. What's the thinking behind it?
Eric, for this week's Trade of the Week, I wanted to highlight a developing divergence in global tech leadership, specifically between U.S. technology and South Korea. The Korean Kospi index has been running hot on the back of the AI memory supercycle. The EWY ETF, which tracks Korea, is up more than 100% since the April Liberation Day lows, a massive move in just 6 months. Samsung and SK Hynix have driven nearly all of that upside. My skepticism is that the rally is extremely narrow. Korea's market is almost entirely leveraged on the memory side of the semiconductor cycle, which makes it inherently more volatile and cyclical. If either of those two names stumble, there's no diversification cushion in that index. And on top of that, geopolitical risk remains an ongoing overhang. South Korean chip makers sit squarely in the middle of the US-China technology fracture, and any change in export policy or restrictions could hit them disproportionately hard. Now, when you compare that to the NASDAQ 100, yes, there's concentration risk in the Mag 7, but it's still a much broader and more structurally diversified index compared to the Kospi. On page 2 of the Trade of the Week chart book, you can see that since the post-Liberation Day trough, the Kospi has nearly doubled the NASDAQ's performance, up 100% versus roughly 50% in the NASDAQ 100. My view is that this gap has likely run its course. Both markets have benefited from the AI boom, but Korea's move looks stretched. From here, there's a strong case that the NASDAQ can outperform the Kospi if the rally continues, and if the markets turn lower, the downside likely to be more severe in South Korea. So to illustrate the trade, I wanted to express this divergence through a straightforward long-short relative value setup. Long US tech via the NASDAQ 100 QQQ and short South Korea via the EWY ETF. The bigger question is how to size the trade. Do you equal the nominal dollars, or does one volatility adjust, since the implied volatility on EWY has doubled in the last 2 months, up from 22% to 44%, while the QQQ volatility remains around 20%. While there's a case for scaling by volatility, I'll lean toward the dollar neutral structure with the equal notional exposure on each side, given that there's a good chance the South Korean implied volatility normalizes back to historical levels over the interim period. Now, another way to add some convexity to the trade is to replace the outright short position in the EWI with a high delta, deep in the money put. For example, the December 115 put, which currently carries about a 90-cent delta, provides nearly full downside participation while introducing positive convexity if Kospi keeps ripping higher from here. This approach not only cushions some of the upside pain, but also makes the trade more accessible for investors who have restrictions or limitations around short selling. You still capture the directional move if the rally starts to unwind, but you're doing it with a defined risk and a bit of optionality premium working in your favor.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
Eric, what are your thoughts into equities?
Well, Patrick, as I've said before, I think we're in the early stages of a secular inflation, and the trap here is everybody mentally associates inflation with really bad for the stock market. It's only really bad for the stock market after a bunch of feedback loops kick in that haven't kicked in yet. It's really good for the stock market in the beginning, and that's what sets everybody off thinking that the inflation isn't really happening. Well, that's what I think the setup is here, and I think we've got a while left before those feedback loops kick in. So I think this market can continue higher in the intermediate term, but boy, it is feeling kind of bubblicious up here. So I really don't have any strong directional view, but bigger picture, I think we probably go higher first and eventually face some serious headwinds as this inflation really kicks into gear. But right now we're in the early stages.
Well, Eric, certainly there's a possibility that the bull trend continues on the S&P. It continues to make higher highs, higher lows, stay in primary bull trend. But underneath the surface, there are some concerns. First of all, I want to highlight the breadth of the market continues to be awful. We're sitting around 40% of stocks above their 50-day moving average, which means 60% of stocks are downtrending right now. In addition to that, and we're seeing sectors like the financials not participating, they're getting very heavy and rolling over. So this market is increasingly reliant on the Mag 7 continuing to rally. And while certainly we're seeing strength in Google and Amazon and names like this really will rely on the semiconductors continuing to rip, which brings that focal point of NVIDIA's earnings coming in a few weeks, which could actually end up being a key pivot point. So maybe we have markets that hold up here and maybe even make new highs over the next couple of weeks. And likely NVIDIA's earnings is going to decide whether or not this rally still has legs for a year-end push. Now, from a technical level, what are the things to watch? Well, the market here just pulled back straight into a 50% retracement of its prior advance, finding support along its 50-day moving average. This is still bullish pattern, which is that if it's bought on dip here and pushes higher, then everything is fine. Where I would start to have concerns if this market started to crack below 6,700, and the more important level is below 6,600, because at some juncture, there's this big air pocket of systematic traders that would end up having to deleverage and or flip positioning, which could put $100+ billion to hit the bid systematically. To me, we're not at that moment where that vulnerability is there, but really the bulls need to keep this pattern of higher highs and higher lows going in order to keep that market away from that danger zone. All right, Eric, let's touch on that dollar.
Well, the Dixie is flirting with 100 this week, right on the edge of an upside breakout from the consolidation range, but it's not a breakout yet. So it's either topping here, right at its resistance level, at its key resistance level, or perhaps we're about to break out to the upside. I think headlines are going to drive this. I have no idea what President Trump and Secretary Bessent have in mind next, but I suspect it will be their actions that determines what happens to the Dixie next from here.
Well, for me, Eric, the dollar continues to actually be setting up for a potential bull continuation. And this could be a genuine disruptor on an intermarket basis, because a lot of the reflation trade assets that have been working so very well throughout the entire year were on the back of a weak US dollar. And it's been a consensus bearish positioning on the dollar. So if we have a counter trend trade, it offers an opportunity to be quite the disruptor to a lot of the bigger investment themes. So is there room for continuation? Well, look, we see substantial breakdowns in the pound. The euro's rolled over. The US dollar yen keeps making higher highs. The US dollar CAD makes higher highs. We have structurally strength in the US dollar against a lot of these cross currencies. And so for me, as we see this double bottom and basing formation developing in the dollar, it's going to be very interesting to see whether or not some sort of a short squeeze can ensue here that squeezes that US dollar up to 103, 104 on the upside. Eric, what are your thoughts here on crude oil?
Well, Patrick, once again, we seem to be stabilizing right around $60 WTI. I still say anything's possible from here. Seasonality stays bearish until February or so. I wouldn't be surprised if there's another $10 or $15 even of downside from here in crude oil prices before the next really big move happens to the upside. So I do think the big move that comes next is an upside move, but I don't think it's time yet, and I see plenty of room for lower prices before it happens.
So, Eric, I want to address your point about the downside. Well, look, we continuously are seeing lower highs, lower lows developing. This primary downtrend of crude oil is still intact. And we do have a key support line that if we had any technical breakdown of that support, it could create some short-term liquidity issues that could cause crude oil to have that short-term kind of washout that you're implying. That's always a short-term risk, one that I think can be easily hedged out. Overall, I think from an asymmetry perspective, I actually think the upside is much more compelling on crude oil, even in spite of that short-term volatility risk. I think the asymmetry remains skewed to the upside. And in fact, I think that the best thing to do here is to potentially have light positioning in and having some of that downside hedged out and have some skin in the game to see whether or not the bulls can crack that 50-day moving average and spur a little bit of short squeeze on the upside. We'll be watching what the next price move is. There's some key levels around the $62 level on crude. If the bulls can beat it, it could create a feedback mechanism that could squeeze the crude oil up into the high 60s. All right, Eric, let's move on to gold here.
Well, Patrick, I'm on the fence between Ola Hansen's view that the next leg higher in this gold bull market will be a 2026 story versus maybe a different view that a sooner higher move might be in the cards already. The reason I say that, the slow stochastics and the RSI both went from extreme overbought to oversold. The stochastics haven't flashed a buy signal like this since late August, just before the meteoric $1,000 rise from 34 $400 to 4,400 began. Now, we just got that same signal on the stochastics. The RSI hit oversold too. The RSI didn't even give us that oversold buy signal back in August. We're getting it now. So arguably, we're getting a stronger buy signal from the technical indicators than we did back in August, just before that $1,000 rise. Does that mean I think we're about to see the next measured move $1,000 higher from here up, to 5,000? Well, I see a few signs that might happen if the dollar doesn't explode higher, but I still think that's possible. So how the dollar situation resolves itself from testing the high end of its consolidation range, I think is definitely going to be relevant here. But potentially we could have a setup here for a sooner than expected upside resolution to the present consolidation pattern that we're experiencing in gold.
Eric, technically, you can definitely observe some short-term oversold conditions, which have now seen gold and silver do 50% retracements of their prior rises. The question here is this a bigger correction, or is this simply a consolidation from a very overbought market? From my perspective, Eric, I think gold can put in its bottom this year, but the question is, can we see gold surpass its previous high this calendar year? I think that we could see a little bit of a compromise between Oli's view and yours, which is that we do put in short-term lows. We could see gold strengthen off of those lows, and maybe the break to new 52-week highs or new highs happens in the new year. One way or another, I still am structurally bullish gold and silver. This entire pullback I'm viewing as a big buy on dip and a correction for a continuation pattern into a new bull move still into 2026. Eric, let's talk uranium.
Well, it makes perfect sense that we're consolidating here after the news flow calmed down. Well, the last big piece of news that we had was the news of the U.S. government buying into and subsidizing Westinghouse building a bunch more of their AP1000 power plants. We haven't had super califragilistic positive bullish news in almost a whole week now, so it makes sense that we're consolidating on the back of a whole bunch of positive news flow. All indications are that the bull case is as strong as ever. The one big systemic risk that I see that could screw this all up for us, or at least present a wrinkle in the long-term, very bullish nuclear story would be if the AI trade started to be unwound, because I think a lot of the nuclear trade has benefited from AI sentiment tailwinds, if you will. If that tailwind turned into a headwind, if there was a reversal of the AI trade, that would be a big risk to our nuclear stocks, including the uranium miners. But that's the only big risk that I see right now. Otherwise, I think it's an incredibly bullish story.
Eric, I want to focus specifically on the URA, which is the uranium ETF of all those stocks. And obviously, there was that positive news that came from Cameco that caused it to break to higher highs. And what's interesting is the URA faded all of that strength back down to the lows where it was trading here in October. So for me, this is the first price action that is showing a little bit of heaviness. While this is not in any way broken its primary bull uptrend, this type of price action is at least showing that uranium is starting to get tired after having a pretty epic 6-month bull run. Now, the question here is it overdue now for a little bit of a longer or deeper market correction, or is it just going to bull continue from here? I'm at this point very neutral. I'm not loaded up on uranium here. I'm going to see if we're going to get some buying opportunities on a little bit deeper dips.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
What we've seen is that a short-term bottom developed around 390, very short-term trip below 4%. And since the FOMC, we've seen some reversion, which is the yield is now picked up to about 410. We now are in a situation, well, is this primary downtrend of yields going to persist? Well, I think that what's happened with the lack of economic data being released because of the shutdown and the Fed basically cooling everyone's ambitions of a dovish Fed off during the meeting, we could end up seeing a bit of a trade range here until there becomes more clarity. I wouldn't be surprised if we chop around here through much of November and that the bigger move develops into the December FOMC meeting.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.